You are listening to the Yield to Reason podcast, where we strive to help you build the most important part of your retirement strategy. Because a retirement plan built with robust income sources is a retirement plan built for success. I am Brandon Roberts. This is episode number 2. Thank you so much for joining me. Today is all about laying a solid foundation by giving you 5 recommendations for income-focused investments you can use to build retirement income. It's time for the rubber to meet the road as we set off on a journey to help you build the retirement you deserve and the one you actually want. So, as we begin today's discussion, we're going to be using the term investment, and I am going to use it somewhat loosely and cautiously to tell you that investment is a somewhat regulated term. And in the world of financial planning, investment planning, there are certain powers that would tell you some things can be called investments and some things cannot be called investments. And some of the items on this list fall into the category of things that can't technically be called investments. And so understand that I am using the term figuratively here, kind of in the same sense that your grandma would when she tells you it's time to invest in a new pair of shoes. So these are options, they're strategies. I also want you to know that none of this discussion is specifically tailored advice. This is information that is being made available for educational purposes only. I'm not an investment advisor, nor am I seeking to become your investment advisor. Several of the items on this list do involve risk, and you should investigate them individually and compare them to your specific needs and your specific risk tolerances to decide if they make sense to you. And with that out of the way, let's get to the list. First up on the list is closed-end funds, arguably the king of investment income, well known for their high yields, and well known for a couple of other things that we'll get into that are good and then maybe some people think not so good. What exactly is a closed-end fund? It's essentially a mutual fund with a very unique quirk, and that quirk is the fact that it does not have the ability to create additional shares for new investors. So typical mutual fund functions with the ability to generate new shares for new money coming in. Closed-end funds, on the other hand, are issued with a set number of shares outstanding, and that's it. Those shares trade on the open market, the secondary market, the same place that you would go and buy shares of Apple or Microsoft or Tesla. And because closed-end funds are technically mutual fund-like products, they do have an NAV. And you will notice, if you look at them, that the price that you pay for a share in a closed-end fund is rarely ever going to match the NAV of the closed-end funds. And there are some people who believe there's some sort of voodoo that can be employed here that would allow you to speculate on price movement of the share in a closed-end fund as it currently sits on the open market relative to its NAV. So in other words, if the price of a share of a closed-end fund is currently at a premium, which means it's higher than the NAV of the closed-end fund, that indicates that the share prices are going to go down sometime soon. Inversely, if the share prices are trading at a discount, which means they're less than the NAV, well, they're probably going to go up to match the NAV, so this may be a good buying opportunity. I'm going to tell you that's all hokum. I've invested in closed-end funds for a number of years personally, and I have never been able to identify a trend of discounts to premiums and share prices moving in any direction because of it. Some closed-end funds always trade at a discount. Some always trade at a premium. They rarely ever change in that regard. And so the forces that push prices of a closed-end fund in one direction are not necessarily things that are easily reconcilable in an accounting kind of standpoint. So just because a closed-end fund is trading at a discount or a premium doesn't make it good or bad. It doesn't mean it's going to move in a specific way. Sometimes they're just at the price that they're at because they're just at the price that they're at. And I wouldn't spend a lot of time trying to guess where it's going to go from here based on that information alone, nor would I necessarily avoid a closed-end fund because share prices are at some relative distance from their NAV. In experience, it's never really made a big difference. Now, when it comes to the style of investment activity or exposure that you can get in a closed-end fund, there's going to be a wide array of options, but the most dominant one is going to be debt-style investment. So most people would associate that with bonds, and that's true. However, there is more sophistication to debt-style investment than just bonds as we traditionally understand it. And I can assure you that closed-end funds engage in basically all of the debt-style investment options that are out there. And they can be quite varied and quite different in terms of how they operate and what various economic conditions may cause certain circumstances. But it is that focus on debt-style investing that does generally give closed-end funds a high leg up when it comes to the yields they can produce as a high-yielding investment. Now, a really cool aspect of closed-end funds, at least in my mind, is the fact that they do have a legal obligation to return a certain percentage of profits to shareholders. So when you buy into a closed-end fund, not only are you entering this with the idea that this is going to be a good yielding investment, but you have the backing of certain obligations, legal obligations that the fund has to give you some of the money, the profit that it produces. There's not necessarily the same obligation in place with a number of different investments out there that you can make on the open market. But, there are some things about closed-end funds that people don't like. And if you go investigating closed-end funds, you're probably going to find these objections to closed-end funds brought up. So let's address them. Number one, fees. If you look at the fees assessed against a closed-end fund, they're going to appear comparatively very high relative to a number of the low-cost index investment options that exist these days. It is very, very common to find expense numbers for closed-end funds in the 1.5% to 2.5% range, which seems outrageous when you compare it to something like take the VOO, the Vanguard S&P 500 Index ETF, which has an expense ratio of 0.03%. So for $100,000 invested, you're being charged tens of dollars in expenses. That seems like a much better deal than 1.5-2% paid to a closed-end fund. But here's the big difference that most people don't necessarily understand at first glance about closed-end funds. Those expenses are not deducted from value of your investment. Closed-end fund fees are taken from gross income generated by the fund. So the 1.5-2% number, whatever it is not going to be a deduction from your investment. If you have $100,000 invested in a closed-end fund and you look up the fees and it says 2%, that does not mean you're going to have $2,000 deducted from your investment every year. What it means is the closed-end fund is taking 2% of the income it produces and then paying you the remainder. And I want to be clear about the fact that when you look at yields as reported in a quote for a closed-end fund, those yields are all net numbers. So when you pull up a quote on a closed-end fund that tells you it has an 8% yield, that means if you invest $100,000, you're going to get paid $8,000 annually, and you're actually going to get paid $8,000. That fee, whatever it is, let's say it's 2%, that doesn't come out of the $8,000 you're going to get paid. That's taken before that $8,000 is arrived at. So while the expenses might seem really, really high, they don't function the same way that expenses as they are quoted for things like ETFs and mutual funds function. The other thing that often scares people about closed-end funds is the fact that most of them use leverage. So they're borrowing money to then invest dollars and pursue their various investment activity. And there's a number of people out there who view the practice of borrowing money as risky. And to a certain degree, it is. But I do want you to understand that closed-end funds generally are not making speculative bets. In fact, they're never making speculative bets when they borrow money to invest it. What they're doing, it looks something like they can buy a new bond issuance and collect 6% on that, but they can borrow and pay 4% on the loan. So they'll pay 4%, but they'll earn 6%. There's a spread that'll result in positive income. They do that kind of borrowing all the time. That's the leverage that is being applied with closed-end funds. And they have to do this in part because they don't have the ability to raise additional capital by taking on additional investors. They've issued the shares that are outstanding. They don't have a whole lot of options for raising more money, so borrowing is their primary mechanism to get more money to pursue investment activity. If the investment return doesn't justify the cost of borrowing, they don't do it. You can, however, buy closed-end funds that use very little to zero leverage. I don't think you need to limit your selection criteria to something like only closed-end funds that don't use leverage. I think you'll eliminate a lot of really good options in the world of closed-end funds. But if you want to do that, you can do that. And there are tools that you can use to screen closed-end funds. CEF Connect, found at cefconnect.com, is the best tool I've found to quickly and for free use a certain number of attributes you're looking for and create a list of potential closed-end funds to investigate further to find out if you want to actually make an investment in them. So, great yielding assets. Couple of unique quirks that they do have about them, but fantastic option for high yielding investment. Next on the list, annuities. This one's going to have a big range in terms of people who love it and hate it. There's a lot that is said about annuities all over the internet and other places. I'm not interested in that debate. All I want to tell you is that annuities have an exceptional ability to create guaranteed lifetime income, and we can't overlook that in the pursuit of building an income-focused portfolio. Annuities are great yield income tools. They're kind of okay to probably a little less than just okay when it comes to accumulation, and that, I think, is what really gets a lot of people to kind of look at them in a meh kind of fashion. Modern financial planning really focuses a lot on accumulation. Annuities don't do well in that regard, so they often get overlooked or kind of put down in those circles. But when it comes to annuities, their ability to provide yield is quite strong and should be at least looked at. They come in a variety of different flavors. We have fixed annuities, we have fixed index annuities, we have variable annuities, we have income-only annuities, we have special style annuities that work kind of like bank CDs. So those are all the various options of annuities that exist. Some of them can come with pretty high fees. So it is something to be on the lookout for and to be a bit cautious about. The fees tend to get much more exorbitant as somebody tries to add additional guaranteed features to an annuity, which may or may not be necessary. They're also not a particularly easy or friendly product to somebody who's trying to DIY their portfolio. You can't just buy direct annuities in the same sense that you would buy shares of publicly traded stocks, mutual funds in your brokerage account. Annuities would need the interaction with an insurance agent in order to purchase one in most cases. Some of the big brokerage companies do have an annuity platform that you can kind of buy in a sense that almost feels direct, though it's not necessarily. But for that reason, the super into I'm going to do everything on my own, I don't need an advisor kind of individual annuities, they're just kind of a trickier thing to do based on that. They're also kind of hard to compare. Difficult to kind of look at various annuities and figure out, all right, what's the list? What's the one on the top of the list? Am I getting the best deal? There are a couple of screening options that are out there for specific types of annuities. Like I mentioned earlier, income-only annuities. Those style of annuities you can evaluate pretty easily at places like immediateannuities.com to plug in your age, the amount of money you want to put in, and look for who's paying the most in terms of lifetime guaranteed income. You can also do it in reverse. So I'm looking for a certain amount of lifetime income. How much am I going to have to pay for that? That resource has been around for a very, very long time. They don't have everybody that's in the marketplace of annuities, but they have most everybody. And that's a really great way to get us a handle on what buying a specific guaranteed income stream is going to cost in terms of money commitment if you want to look at it. So again, great yielding option. Little trickier to compare in a lot of regards. You might need the assistance of an insurance agent, or most likely will need the assistance of an insurance agent to really make a comparison there. But don't overlook the power of guaranteed income when it comes to an income portfolio. From a strategy point of view, I think there's a lot of power in a portfolio that has guaranteed income to the degree that it can cover your essential sort of non-negotiable monthly expenses. For a lot of people, when they get to retirement, Social Security will take a lot of that up. It can certainly do that. But for most people, it's probably going to be inadequate covering everything. And that's an area that you can fill in with annuities and be quite successful with it. Next up on the list, real estate. I'm going to start the real estate discussion by noting my personal bias here. Real estate is not my cup of tea. I personally don't love real estate as an investment option, but that doesn't mean that I'm going to tell you it's a bad idea, because real estate is certainly an asset people have pursued to build significant income streams. And so if you want to put in the work, and trust me, it's a lot of work, then there is an award for it, and it can be quite great. But I really want to emphasize, it's a lot of work. People who are actively engaged in being real estate investors are usually pretty serious about what they do, and you're going to have to compete with them if you want to be in real estate. So that makes it somewhat more complicated. Does require more money than some of the items on this list typically do. And the one thing I want to sort of point out, the one message I want to convey is, don't listen to the people who are trying to sell you on this dream of work super part-time in your PJs and build a real estate empire. That is extremely difficult, if not impossible to do. Get ready to roll your sleeves up and do a fair amount of work for a number of years, and then you can probably work part-time in your PJs and be just fine. But investing in real estate, somewhat difficult. Not necessarily my favorite thing in the world. We'll revisit real estate in future episodes with other people who have been much more actively engaged in real estate investment than I have ever been, to give more insights on it. But there's also other ways to do real estate without as direct a traditional investment as people usually think of buying apartment buildings or houses and renting them out. You can do real estate syndicates. Typically requires a decent amount of capital to buy into those, but an option that gives you less direct investment activity in real estate, less obligation on you to manage real estate assets. Or even easier than that, you can buy REITs. And I know REITs have been kind of beat down a bit in the last 5-ish years because there's several economic forces that made REITs from an appreciation standpoint far less attractive. COVID definitely beat REITs down. Commercial real estate took a big hit with COVID. Plus, when interest rates go up and treasuries are higher yielding, people move out of higher, riskier yielding items and into low risk items or lower risk items. Treasuries being a key one. And the demand that pulls away from things like REITs and even closed-end funds tends to push prices down on shares. And that makes people who own them take a on-paper loss, which not everybody loves. That being said, throughout the past 5 years, REITs have continued to pay fantastic yields. And REITs, like closed-end funds, do have obligations to return profits to shareholders. So if you invested in REITs over the past 5 years, you might have seen the share price go down. So again, you might be able to sell at a capital loss. But you've also probably seen yield go up quite considerably because you've been buying at ever lower share prices, which isn't such a bad scenario to find yourself in when you're trying to build a better income style portfolio. REITs are the only real estate exposure I have these days, and it's the only real estate exposure I want. So they're not bad. I actually like them quite a bit, And if you like the idea of real estate for various theoretical reasons, REITs are a fantastic way to do it, especially with a lower commitment of capital and certainly lower commitment of time. Next on the list, bank CDs. So this one is for all of my extremely conservative saver investor friends. Bank CDs were at one time kind of the default conventional wisdom of what average Americans did with their retirement savings. You retired, you bought up a bunch of CDs, and you lived off the interest. And all that basically died in the mid to late 2000s. But certain circumstances in the economy have breathed new life into this idea, and it's started to become more popular again because we have yields that are significantly higher on CDs than existed for the past 15 years. But definitely something the much more conservative style saver or investor is interested in most of the time. Brings a whole lot of peace of mind to the table. The fact that CDs are generally FDIC or NCOA insured also brings an additional layer of security that people just like. Now, I personally think CDs are a bit riskier than most people realize for two fundamental reasons. First, generally speaking, CDs are purchased at smaller, more regional banks versus a Citibank or a Wells Fargo or a JP Morgan, because those large banks don't generally have the best CD rates. And those smaller regional banks aren't as well capitalized most of the time. Some are, but most not. And they tend to be where the majority of bank failures take place, and that just involves some degree of risk. Second, and more importantly in my mind, CDs don't guarantee interest for a very long period of time. So in general, 5 years is kind of the long end of the range of CD guaranteed periods. And most people are going to need income for longer than 5 years. So when you buy into a CD, even if it's got really killer rates, generally speaking, you're only going to guarantee that for 5 years. And there are various strategies people use to try and spread that out, laddering being the key strategy that involves buying different CDs at different times with different guaranteed periods, trying to diversify when CDs are going to renew on you. But again, 5 years is kind of the general max in most cases for CDs, and it's just not long enough to really solidly guarantee yourself a long-term income. And CD interest rates can be very volatile. They're extremely sensitive to movements in interest rate policy. And we don't even necessarily need to see broader market interest rates fall. We just need the Fed to say that it plans on rates going down, and we generally see CD rates drop pretty rapidly. And in my experience, most people don't really do a lot of planning in between inception and renewal. So when they buy a CD, if it's paying them a really great interest rate that they're very happy with, they don't really think much about it until renewal time. And by the time renewal time rolls around, the CD reentry renewal may be significantly less than it was when they bought it 5 years ago, let's say. And now they find themselves in a bit of a rushed circumstance to figure out where the money's going to go now. Yes, we could kind of get out in front of that, hedge a bit of it if we planned ahead of time, but it's rare for people who buy CDs to do that. So does create a bit of a problem for people. Now, modern technology does allow a lot of people to access CDs from any corner of the country. So you can shop CD rates not just at the downtown bank, but all over the nation and try to find who's got the best interest rates for you. Interestingly, though, that's a bit of an incongruent behavior pattern for CD people, I would say. Most really conservative types, they kind of enjoy or need that face-to-face social interaction when it comes to transacting this kind of business. So their openness to buying a CD from an unknown bank somewhere 1,000 miles away from them, not something they're generally all that excited to do. But if you have a little bit of that conservatism in you, but you also kind of like to embrace modern technology, it might work. Not going to be the highest yielding option on the list, not at all, but certainly one that conjures up a whole bunch of warm and fuzzies, and people love it. That's why they still exist, and it would be foolish to overlook it as an option. Last item on our list is options contracts, puts and calls. And this one is definitely for the advanced crowd only. But I will tell you, if you want to spend the time figuring this one out and you're okay with the risk profile that this one involves, you can make a lot of money doing this. So I am speaking specifically about writing puts and calls, not speculatively buying them. And let's start by just explaining what puts and calls are. So they're contracts, they're option contracts, they're issued against securities that trade on the open market. So when you buy a call option, a call option is a contract that obligates one person, the issuer of the contract, to sell a security at a certain price within a certain time frame if the buyer of the call decides to enforce the contract. A put, conversely, obligates the issuer of the contract to buy a security at a certain price within a certain time frame if the buyer of the contract decides to exercise the contract and force the issuer of the contract to, again, purchase the security at a certain price at a certain time. Now, I mentioned already, I am not talking about speculatively buying these contracts to try and take advantage of some big price movement in juice returns. That is an option that people do pursue every day, but that's not going to do much for income building on a portfolio. What we're talking about here is the process of writing. So issuing, you are issuing the contracts, calls and or puts, and we're talking about doing it in a covered fashion. So covered calls or covered puts. That does not mean you are buying the contract and potentially losing all of the value of the contract. Instead, you're the one issuing the contract and collecting the premium that the other party has to pay in order to buy the contract. Let's go over covered calls and covered puts. So on a covered call, which is generally the more common strategy that people employ, you own a position. Maybe it's Apple. Maybe it's Microsoft. Maybe it's NVIDIA. And you want to issue calls against that position. That means you are going to write contracts that allow somebody, if they choose to exercise the contract, to purchase those shares from you at a certain price within a certain time frame. The person who buys that contract from you is going to pay you money to gain that ability. If the price that you agree upon in the contract is never reached within the time frame that the contract is issued, then the contract expires with zero value, and you collected the premium from issuing that contract, which means you didn't actually have to sell your position, but you got paid for issuing the contract. So for example, let's say you own Apple. Apple's trading at $200 a share, and you issue calls against your Apple position with an expiration of this Friday for $210 as the strike price. That's what we call it. That means that if Apple gets to some price above $210, the person who bought those shares from you will have the option to purchase your shares at the agreed upon price and then immediately sell them on the open market for the higher price that they could get for them. That is the risk that you are facing when you issue covered calls. But if Apple never gets to that $210 price, then the contract expires with zero value, but you still got paid to issue the contract. Alternatively, you can issue covered puts. So in this case, you don't own the position. You just have cash on hand. And what you're doing is saying, all right, I will issue a put on Apple, let's say for $190 a share when it's trading at $200. And now, instead of worrying about Apple getting to some price above $210, I'm worried about Apple dropping below a price of $290. So I don't own anything. If Apple gets below $190, somebody can force me to buy it. And let's say Apple gets to $185. They could force me to buy at $190, And what they would do is they would buy at 185 and then immediately sell to me at 190. That's how the put side of this would work. So you can collect income with puts and calls, whether you own the position or you don't own the position, but you've got to have cash if you don't own the position. That would make it covered for you. So you're not speculating. You're not running yourself into a position where you would have to suddenly come up with more money to purchase the security when you're doing a covered put. As you can probably tell, this one requires a good bit more amount of investment sophistication than any of the other items on our list. It's also riskier than any of the other things on our list. It's also something that you're not going to do if you don't have a decent amount of money on hand. It's certainly not a strategy for somebody who's starting out and they got $5,000 in their brokerage account. Outside of real estate, it's one of, if not the item on the list that's going to require the most amount of capital on hand to employ. But it's also an excellent way to create additional yield from your portfolio. And if you want to maintain a little bit of accumulation exposure, it's actually a really great way to get paid for owning various shares of something that you feel is going to continue to grow in value. You can write calls against major shares of major companies traded on the stock market. You can also write calls or puts against major indices, so the S&P 500 or the NASDAQ as an example. Now, if you have less money, or you're just not that comfortable with doing it yourself, but you like this idea, there are options that you can use, and I mean options in the technical sense, not the contract sense. So there are strategies that you can use to get into this style of investment without actually purchasing puts and calls yourself. There are a few different ETFs out there and closed-end funds that engage in covered call strategies. So the ETF company Global X has the QYLD and the XYLD. Those are covered call strategies that are done against the NASDAQ and the S&P 500 respectively. A year or so ago, JP Morgan Investments rolled out the JEPQ and the JEPI, similar idea. So these exist for you to basically get exposure to the same strategy, but you're not yourself having to get into the business of issuing puts and calls, which means you can do this with less money at that point. And again, I mentioned there's closed-end funds that'll do this, but the ETFs in particular, you're looking at yields typically in the 8 to 12% range, which is very, very solid. And you're not getting as much exposure risk in terms of price volatility as you would normally have if you just bought, let's say, a NASDAQ or an S&P 500 index fund, and all the while you're collecting income from it. Not going to appreciate like an investment in a NASDAQ or S&P 500 index fund would either. So be aware that the year over year growth of that's going to look far different than what you would get if you just had a passive ETF index fund. But a great way to get exposure to it. One other thing to note about this. So if you choose to make an investment in one of these style ETFs, your brokerage platform is almost certainly going to make you change your investment risk profile to a very aggressive profile if it's not set there already. The logic behind this is that you're using investment products that do generally involve a decent amount of risk, and so that would necessitate a more aggressive risk profile. Writing covered calls is actually a pretty conservative investment strategy in my opinion, but I don't get to make the rules on that. Just understand that if you choose to go make an investment in something like a covered call ETF, your brokerage platform is probably going to tell you, if you don't have an aggressive risk profile chosen on record, that your risk profile doesn't match the investment objective of this asset, so you can't invest in it, or you're going to have to change your profile in order to invest in it. And that's the list. 5 options for high-yielding investments to start building your income-focused portfolio. Again, the list is closed-end funds, annuities, real estate, bank CDs, and derivatives, options, contracts, puts, and calls. That is all we have time for today, I am afraid, but have no fear. We'll be back next week with more tips and tricks to help you build your retirement income-focused portfolio. And until then, please keep in mind that real wealth doesn't just add up, it writes checks.